Sold out.
The banks got bailed out.
In the wake of the worst economic crisis since the Great Depression, Wall Street and Washington are fighting over how to fix the nation's financial regulatory system. President Obama says he aims to rein in a financial sector gone wild. At the center of this reform is the president's call for an entirely new federal overseer, the Consumer Financial Protection Agency.
Consumers shouldn't have to worry about loan contracts designed to be unintelligible, hidden fees attached to their mortgage, and financial penalties.
The CFPA would write and enforce new rules on credit cards, mortgages, and other financial products. But the White House must still overcome, or convert, a host of opponents to the idea. Industry poses the toughest opposition to Obama's consumer plan, and the U.S. Chamber of Commerce, the nation's largest lobby group, is leading the way. The chamber launched a $2 million ad campaign to kill the CFPA, making small businesses like butchers and bakers the face of their opposition. The big banks are not far behind. President of the American Bankers Association, Edward Yingling, has been front and center opposing the CFPA, telling the Senate Banking Committee this summer that the current system would work if existing laws were enforced. Yingling is a force on Capitol Hill, with a 30-year history of fighting for financial deregulation among an elite circle of Washington and Wall Street heavyweights like Bank of America. Obama also faces a battle with government regulators. The top three financial regulators are wary of, if not outright opposed to, the new agency. The Federal Reserve sets the nation's monetary policy, but it is also supposed to police how banks deal with their customers. Fed Chairman Ben Bernanke says oversight of the financial system and consumer protection are closely tied. The CFPA would separate those functions, and Bernanke argues make it harder for the Fed to do its job. Sheila Bair, chairwoman of the Federal Deposit Insurance Corporation, has endorsed the CFPA as a way to standardize consumer-related rules, but she says the agency should leave bank examinations with the current regulators. Another federal regulator, the Office of the Comptroller of the Currency, relies on fees from the 1,600 commercial banks that it charters. It stands to lose the most authority in the CFPA fight. The CFPA would try to make all banks play by the same basic rules. If the agency existed a few years ago, there might have been a different outcome in a West Virginia case. In 2005, that state's Attorney General began investigating Virginia-based Capital One for alleged deceptive lending. Instead of submitting to a state ruling in the case, Capital One found refuge with the Office of the Comptroller of the Currency, swapping its state charter for a federal one. West Virginia now lacked jurisdiction in the case. It's details like these that are being hashed out on Capitol Hill, where Barney Frank's House Financial Services Committee has taken the lead on defining the legislation. Republicans have been almost uniformly opposed, arguing that more regulation would lead to increased costs for consumers.
I'm not really sure how you raise the price of credit, how you raise the price of all these different services, and somehow call that pro-consumer.
Democrats also have concerns and have come under fire for scaling back pieces of the proposal. For instance, one of the CFPA's original champions, Democrat Brad Miller, added an amendment to exclude banks with less than $10 billion in assets, meaning 98% of the nation's banks would be exempt from CFPA enforcement.
The industry really is concentrated in the biggest banks, and they are the ones who did the bad stuff.
The next challenge lies in the Senate, where Democrats are even warier and every vote will count.
I think we're going to hold together pretty well, and we might lose a few votes. We've lost one in committee on some of the critical votes so far, but one isn't enough to matter in the House. One in the Senate, however, kills you.